Life insurance as an investment. It's interesting because a lot of times when I talk to people about this, they've never even thought about the possibility of having those two things together. Well, today we're going to break down how to use life insurance as an investment in 2023. And if you're new to this channel and you don't know who I am, it's nice to finally meet you. My name is Mckensy Long. I have been an entrepreneur, especially in the financial services industry, for over a decade. And through that time, I have helped thousands of people become educated when it comes to money, and also helped hundreds of agents come into the industry. And what we're talking about specifically today is using life insurance as an investment in 2023. And in order to do this, we have to explain some concepts so that we can have some common language. I'm assuming you probably don't know a lot about investments, so let's make sure we at least have some common ground to be able to work from. Number one is understanding the concept of compound interest. Now, a lot of people say that they understand compound, it's the building of things over time, but yet they don't really seem to apply it to their life. So an easy way to understand this is the compounding effect. They use an old banker's rule called the rule of 72, which means if you take your interest rate and you divide it by 72, it gives you the number of years for your money to double. So if you were to get a 1% rate of return, it means that your money is going to double in 72 years. So if you're 19 years old and you have $10,000, by the time that you're 67 years old, you're going to have about $16,000. The challenge with that, it's too little growth and too late, too much time, it takes too long. But if you can get a 12% rate of return with that same $10,000 from 19 years old till 67 years old, you will have over $2.5 million saved. That's a huge difference. 16,000, 2.5 million. Huge difference, and the only change is getting a better rate of return. But with that comes a lot of risk. If you've seen what's going on with banks right now and what's going on in the crypto space, people felt like they were making a bunch of money, but what they don't understand is the risk behind it over a long period of time. And so there's really three different ways that we can look at risk. The first is going to be fixed. This is kind of going to be our bank account, maybe a CD, something like that, where you can get a 1, 2, maybe 3% rate of return. The challenge is it grows slowly. The good part is it's consistently. The downside to it is it just doesn't grow enough. So then what most people turn to is very risky things. They seem to be on both ends of the spectrum. So they jump all the way into crypto or NFTs or things like that, even the stock market. The challenge on that side is that you have great potential on the upside, but you also have great potential on the downside. And that's where people kind of freak out. So when you start talking about these things, those are the two ends of the spectrum that most people know and understand. What they don't see is that in the middle is called indexed, and inside of a life insurance policy, you can actually cut off the bottom part of the loss and still keep the upside potential. And most of these insurance companies now have even gone to uncapped strategies to where there's no cap on the upside potential. So as we talked in the first part of compound interest, yes, it's great to get a good rate of return, but we also want to be able to do it consistency without the risk of loss, which leads us oftentimes into that index strategy. But there's one other thing that we also have to take into consideration when we get into retirement, and we can plan for this ahead of time. Number three, I don't know if you know this, but you get to choose how much taxes you would actually like to pay in retirement. And unfortunately, if you don't know how much taxes that you want to pay or you'd like to pay more than zero, the government will allow you to do that by you actually not planning your strategy. Because there's three different ways that we get taxed. The first is tax now. That's going to be things like our money market accounts, our bank accounts, CDs, that kind of stuff. Then we can use things like 401ks and IRAs, which allow us to not get taxed now. We can have a tax savings now, but then that $2.5 million or whatever it is we need to retire, we get to pay taxes on the entire thing in retirement. Or we can do strategy number three, which is tax never, meaning you get your paycheck, you've already paid taxes. once you put it into the program, it grows tax-free and comes out tax-free. So those $2.5 million are your $2.5 million. You don't have to take out the government's cut of maybe $1 million or so out of that. So if you can understand those three concepts, again, we've got to get it to grow, but we want to protect it a little bit, at least from the downside, and we also want to minimize our taxes. But wait, there's still a couple issues that we need to take into consideration that I think a lot of people forget. What happens if we die too soon? What if things don't go as planned? Well, then we need some form of life insurance anyway. If things do go as planned and we live a long, glorious life, well then great, we've got the cash value to be able to handle that. And what happens if we live a long life, but we happen to get sick in between? Well, what are we gonna do for that? And this is where I think most people's portfolio doesn't take into consideration what happens if we get sick? What if we need long-term care? What if we need critical illness? That is hundreds of thousands of dollars that is going to be needed. Long-term care is 70% of the population. I believe heart attack and stroke is 48% of the population. Cancer is 40% of the population. So the likelihood that it's not going to be an easy breezy sailing life is very, very high. Yet if we don't take this into consideration, that's a huge chunk of money that comes out of our retirement account that we weren't planning for, but that we know is a likelihood that's going to happen. And there's only one type of product that can handle all of these scenarios, and that is permanent life insurance. So it would probably make sense to have these things built into your program if it doesn't already. So I highly recommend you looking into it, that it does cover all of those different situations. Now, obviously, everybody's situation is different, but if you want to see something more specific to you, down below is a link that you can click to actually do a call, and I will send you one of our books as well so you can become even more financially literate. It's the #1 best-selling personal finance book, How Money Works. And I'd love for you to join that community and get additional resources sent directly to your inbox. And as always, don't forget to like, comment, share, do all that good stuff. Don't forget to hit the little bell. We have a ton of additional content coming out that if you want to do better in your life, especially financially, this channel is going to help you. And as always, I hope you have a great day, and I will catch you later. Bye.